Cast is now starting. All attendees are in listen-only mode.
Good afternoon and a warm welcome to all. We apologize for the delay. There was some technical issue. I'm Ridul and on behalf of Care Ratings, welcome you to our today's webinar on foreign portfolio investments and really appreciate your time in joining us for this webinar. To take you further on this, our speakers for today is Kavita Chacko, who is working as senior economist, and along with Kavita, we have Manisha Sachdeva, who is working as associate economist. And as always, the discussion is form of a presentation which is visible on your screen. In case of queries, we'll be having a Q&A session no sooner the presentation ends. I repeat, we'll be having a Q&A session as soon as the presentation ends. If there are any queries, you can please key in the questions in the slot provided. May I request Kavita to begin the session?
Thank you, Mridul. Good afternoon, everybody. In this webinar on foreign portfolio investments, we have examined the overall FPI flows into the country, including the foreign investments into the debt and equity segments, along with factors that have been driving these investments. In addition, the investment utilization limit for the debt segment, as well as the sector-wise FPI flows have been looked at. We have also included the country-wise FPI flows and some recent measures that have been undertaken by policy makers to stimulate FPI inflows. To begin with, we touch upon the importance of FPIs for the country. Foreign portfolio investments are a major source of private capital flows for the Indian economy and are relied upon to fulfill the capital needs and manage the balance of payment position of the country. Foreign inflows have also come to be considered to be a significant driving force of the stock market here. It also has implications for the exchange rate. The flow of FPIs to the Indian market has witnessed a reversal in the current fiscal year after 2 years of high inflows. The outflows this year at around $14 billion is in stark contrast to the inflows of $21.5 billion in the last fiscal. Foreign portfolio inflows into the country have been prone to volatility over the years. A period of high inflows has invariably been followed by either outflows or lower inflows. So far this fiscal year, that is in the first 10 months, net foreign outflows have been around $14 billion, whereas for the comparable period a year ago, the country had received inflows to the tune of $20 billion. Foreign investors have been net sellers in 6 out of the 10 months this fiscal. The highest quantum of outflows on a monthly basis of $5 billion was witnessed in October 2018 at the peak of the rupee depreciation. A similar trend of outflows has been observed in other emerging markets also in recent months. FPIs have been net sellers in both the debt and equity segments in the ongoing fiscal year. The net outflows from the equity market so far this year have been higher at $7.1 billion compared with the $6.8 billion outflows from the debt segment. And now coming to the factors that influence FPI flows, there are various factors that typically influence FPIs. FPIs tend to be significantly impacted by global risk factors and are seen to be often driven by short-term aspects and speculative considerations. The decisions of the foreign investors to invest in a particular country depends on factors such as economic growth, political and social stability of the country, transaction costs involved, market size, market efficiencies, expectations of higher returns, interest rates, inflation, and currency value, to name a few. In case of the current financial year, global and domestic causes alike have prompted the flow of funds from the Indian markets. FPI sentiments towards India weakened since the start of the fiscal year, that is April 18 onwards. The main factors that have contributed to this are the rise in crude oil prices, weakening domestic economic fundamentals, that is the widening current account deficit and concerns over fiscal deficit, the US interest rate hikes and the resulting shrinking yield differentials, the tightening global liquidity conditions with a shift in monetary policy of advanced economies and the US Fed's move to shrink its balance sheet, the global trade developments, and the strengthening of the US dollar and depreciation in the rupee has also been a driving factor. The depreciation in the rupee has been both a cause and effect of foreign fund outflows. The role of depreciation in the domestic currency in affecting FPI flows is nevertheless ambiguous, as net FPI outflows during August to October 2018 was around $7.8 billion when the rupee depreciated by 6% during this period. This is lower than the outflows during April to June, which was $8.8 billion when the currency depreciated by 3%. This indicates that external factors have been the more important drivers of capital flows into India this year. I now request Manisha to take this webinar forward.
Now we look at the FPI limits in the debt segment and its utilization. The investment limits of government securities and corporate bonds were revised by SEBI for the first and second half of the financial year 2018-19. In case of central government securities, the limit was increased from rupees 1.9 lakh crores to rupees 2.07 lakh crores for H1 FY19 and further to rupees 2.23 lakh crores for H2 FY19. Similarly, in case of corporate bonds also, the limit was increased from 2.4 lakh crores to 2.6 lakh crores for H1 FY19 and by an additional rupees 23,000 crores to rupees 2.8 lakh crores for H2 FY19. As of January 16, 2019, 73% of the total FPI limits in central government securities has been utilized by the foreign investors. Likewise, in case of corporate bonds, 70% of the limit has been utilized. It thus indicates a scope for inflows into both these segments. It is to be noted that only 6% of the total FPI limits in state government securities are utilized by the investors as on January 16, 2019. Now a look at the asset under custody shows that equity segment on an average accounts for 87% of the asset under custody, while debt segment accounts for only 14%. Now we move on to the sector-wise FPIs. Here, in case of equities, it is the financial services that has the dominant share of 35%, followed by software services at 12%, oil and gas at 8%, and automobiles at 7%. In terms of sectoral share, it is worth noting that while the share of financial services has increased in recent years from 25% as of end December 2013 to 35% as of end December 2018, that of software services has declined from 17% to 12%. In case of debt segment, sovereign instruments dominate the FPIs. It accounts for 52% of the total investments in the debt segment, followed by the financial services at 13%. Here it needs to be highlighted that a share of financial services has declined from 21% as of end December 13 to 13% as of end December 2018, while that of sovereign has increased from 48% to 52%. Now moving on to the list of countries which have contributed to FPI flows, we see that as of end December 2018, USA has the largest share of around 33% in the total FPIs, followed by Mauritius at 14%, Luxembourg at 10%, and Singapore at 9%. The share of USA and Luxembourg has increased by 2% each since end 2015, while that of Mauritius and Singapore has declined by 7% and 2% respectively during this period. Now, over a period of time, various measures have been initiated by the regulators and policymakers to stimulate FPI inflows. Here I am covering few of those key measures. The limit for FPI investments in outstanding government stock is to be increased by 0.5% each year to 5.5% in FY19 and further to 6% in FY20. The RBI has also increased the FPI cap on investment in government securities from 20% to 30% of the outstanding stock of that particular security. It has also abolished the residual maturity requirement of 3 years for government securities, and for corporate bonds, it has reduced it to 1 year from the earlier 3 years. The government is to review the removal of exposure limit of 20% of FPI's corporate bond portfolio to a single corporate group and 50% to a single company. It's also the RBI in consultation has also proposed a special route called voluntary retention route to encourage FPIs willing to make long-term investments in debt. Lastly, our view for FPI for 2018-19. We believe that FPI flows would continue to be volatile for the remainder of the fiscal. It would be influenced by both domestic and global factors. The equity segment could see inflows fueled by expectations of improved corporate performance and favorable economic prospects for the domestic economy when compared with the other economies. At the same time, uncertainties over the general elections, global equity markets performance, and global political uncertainties regarding US-China trade war and Brexit negotiation could impact investors' sentiments and pose a risk to flows into the segment. The flows into the debt segment could see moderation, with the RBI expected to lower its OMO purchases in the coming months and a pause in the interest rate hike cycle on account of benign inflation. In addition, concerns over the government's fiscal position, the risk of resurgence in crude oil prices, and monetary policy tightening in developed economies would also weigh on debt inflows. On a net basis for the financial year as a whole, the inflows could tend to be marginally negative compared with the positive inflows of $21 billions in FY18, even though the flows in quarter 4 FY19 would be positive. Thank you.
Thank you, Manisha, Kavita. I think by this we come to an end of the presentation. Now we'll be taking a break of 2 minutes before we take your questions. I repeat, we'll be taking a break of 2 minutes before we begin our Q&A session. Thank you.
Welcome back. We have received a few questions here. I'd like to thank everybody for their questions. One of the questions which we have received is why there has been a decline in the share of FPIs from Singapore and Mauritius. This has mainly to do with the change in the tax treaty that we have had with them. So the capital gains tax exemption, which was available to them, has been done away with since 2017, partially since 2017 and fully from 2018. So this is one of the reasons why this has their share has come down. Another question that we have here is what could be the impact of developments on the global front, such as trade war and Brexit, on foreign flows to emerging economies? Uh, as far as the trade wars are concerned, that we can already see the effect of the US-China trade war in terms of the slowing down of the economies across the globe, and this has prompted foreign investor outflows from emerging market economies such as India. So, for further uh, deterioration in these could make these flows more volatile from the emerging market economies. In terms of Brexit, we do not see much of an impact on India. However, any disruptions in the global flows definitely has a direct impact on the allocations to the country and outflows from the Indian markets. Uh, we have a question as to which sector will attract FPIs. What we have seen is financial services has been one of the predominant sectors which has been seeing higher FPIs flows, and that is likely to continue going forward. Also, when it comes to debt, it is the GSECs that have been seeing higher inflows. That too is likely to be followed going. The trajectory is likely to be followed going forward. Another question what we have is how will the tightening of monetary policy of major global central banks and the end of the quantitative easing program alter the foreign investment flows to India? Uh, See, the increase in interest rates in the US does not augur well for emerging economies such as India, and it sees that leads to foreign investors to shift their focus from markets such as India to the US because of the possibility of higher returns there. Yeah. We have received another question as to FPI investments have turned negative during the year. Any analysis on the number of new registrations during the year compared to last year? Unfortunately, we do not have such an analysis here. So, as for the number of registrations, so I'm sorry, I'm unable to answer that.
I think there are no more queries coming in. Probably that was the last question taken up for the day. For a query from Mr. Debel, he's asking about the presentation. I will be sending across to you by mail. With this, we come to an end of the webinar, and we thank the participant for taking your time out and being a part of this discussion. For any feedback, suggestion, you can please write to us in the comment box, which will be coming no sooner the webinar ends. Thank you for now.